Welcome back to the Warlords of Wall Street. Well, the day started off with a bang with the jobless claims coming out. Turns out that they were a little higher than what was expected, which should be seen as decent news over at the Fed. This is the wanted effect of what they're doing. Shouldn't come as a surprise. But for some reason or another, the market didn't like it, and I just don't understand it. But the 10 years started to slide, the 2 years started to slide. And as a result, the market should have been rallying, but the Fed seized Silicon Valley Bank. And it turns out that there may be some serious systemic problems there. They were in such bad shape after the run on it the last 2 days, is that because of their size, essentially a super regional top 20 bank, that everyone started thinking, well, if they're in trouble, they were a darling of the West Coast. Well, then, good Lord, all the regional banks may end up having the exact same problems. With the accelerated pace in which the Fed is, this is the speculation, by the way, with the accelerated rate in which the Fed's raised rates, that ended up having a dire effect on their bond portfolios and essentially made them insolvent. That's purely speculation at this point. What SVB was truly known for, it was prolific in its lending to startup businesses and venture capital loans. And in my humble opinion, I think the problem underneath of it is all of their loans, when the regulators went in there, as they do annually typically for their audits, they found out that a whole bunch of this stuff was probably underwater. And when they started checking the reserves, they found out, yes, the bonds were underwater too. Everybody's bonds are worth less today than they were a year or two ago when the banks buy them. So all of a sudden, next thing you know, somebody says something, they make a phone call, and the word starts to spread in wee Silicon Valley, and then you got to run on the bank. And this is exactly what happens. It's a cause and effect. They say that there's a problem, and everybody takes their money out, and there certainly becomes the problem. This had the chilling effect on all regional banks. Everyone's figuring, well, if they're in trouble, they're all in trouble. And that was just nonsensical to suggest such. SVB is a very unique animal. Arguably, half of the startup ventures that went from SPAC or public have relationships with SVB. Now, that's very speculative business. That's very aggressive banking. And yet, nobody seemed to care. Last year or a year and a half ago, they were $600 a share. Today, they're in the 30s. But this is what ends up happening. The entire market decided to take a crap today. We got, as we told you yesterday, we got stopped out of our position for the third consecutive time of our regional bank stocks. And today, when everything was on fire this morning, we saw the DPST dip all the way down into about 1130, 1140 range. I was wondering, good Lord, is it going to go all the way down into the nines and the tens, which would be some of the ugliest numbers that we've seen support at for this particular ETF in years and years and years. Well, it turns out that once it started to rally back, I'm of the mind that the truists of the world, a lot of the medium-sized, large-size regional banks, this is an overreaction to SVB. It's an overreaction. We came in and we bought this morning, as you'll see on the Patreon account. We came in at 1170, 1171, I believe, to be exact. And within an hour or so, we were out at 14 and a quarter. Turns out I didn't know that it was going to run that fast. I just knew that things were in an oversold condition. The volumes just went off the chart. And when a little bit of sanity settled back in, it started to run back up. However, we got out at 14 and a quarter. And the reason why, and I think it's important that we explain, by coming in on 3 previous occasions, we've actually traded this 4 times in very short order. First time we made our 5-6%. Second time we got stopped out, 5% loss. Third time got stopped out, 5% loss. Fourth time got stopped out, 5% loss. So now I'm essentially, with the last 3 trades, I'm negative 15 in the hole. -9 overall, trading this position in the short term. That's never good. You wouldn't want to brag about that. But in the last 3 trades, -15 thanks to stop losses protecting us. And because those did protect us, we were able to come in at 11 and 71, got out of 14 and a quarter. Turns out we made just a little under 22%. Voila. We've made up for the -15 that we've been hit over the last 2 weeks. We end up making just a little under 22%. Now we're up 7% just on these pullbacks with the stop losses. And overall, we're up about 13. That's great for us. That's all that we wanted, especially with the volatility that's in the market on the regional banks. So we took our money off the table, content that we fixed the problem, took being a little bit aggressive here, but that's the way we tried to do it. When you make a mistake, sometimes you just have to have the courage to jump back in there when everybody else is running for the exits and somebody yells fire. Somebody's got to put on the fireman's hat and go running in to see what's going on. That's what we do. We ride dragons and we respond to fires. So, glad we get to brag about that today. We'll live to fight another day with DPST. The VIX popped up over 24, which is telling us there's some volatility out there and there's some real concern in the market. We went from being under 18 to over 24 in a matter of days. That's not a good move. The treasuries, as I alluded to at the beginning of this, started to pull back. The 2-year was flirting with 5, and now we're somewhere in the 4.56 range on that. That's a big drop, folks, in a very short period of time. That is a flight to quality. There's no doubt about it. The 10-year was floating right about 4%. Now it's around 3.6 or so. That's very nice to see. The rate increase that the Fed it was all but in the bag that we might be looking at a 50 basis point jump, 50 bips. And I even said as much yesterday. We may very well have that coming if these job numbers aren't to their liking. But there is one rule above all others. When you're dealing with the banks and you're dealing with the financial institutions that are literally the foundation of Wall Street, and you have a systemic crisis that SVB was essentially trying to signal that the hyperbole that goes around it, people were going to start fleeing for the exits. Wall Street, the federal government, they can have none of that when it comes to banks. You cannot undermine the confidence of our financial institutions in this country. They were incredibly aggressive back in 2008-9 when we had the banking crisis back then, and this is a shot across the bow, and I can guarantee you, the Fed is going to rethink its position about what it was going to do in a couple weeks with its next rate increase. I'll bet money that we don't see the 50 bips. We may not even see the 25 bips. We may see some jawing about having the data coming in and them needing to sit on their hands for a little bit and just see what this lag effect is. Because clearly there are some effects on the balance sheets of these banks. We know that. And nobody really cares. It's like a duck. It all looks like it's smooth on the surface, but underneath there could be a lot of business going on with their paddling. So we know that they've got some issues with their loans. Everybody does. It's not a bad situation, but everybody's got issues with it. Everybody's bond portfolio is got to be underwater at this point. But so long as somebody doesn't yell fire, nobody goes running for the exits and they don't pull their money. So long as that remains calm and collected, then the business can go right on and everybody knows they'll recover. But when everybody starts yelling, oh my God, run, fire, the banks, are all upside down. They don't have solvency. And then all of a sudden, you listen to that hyperbole and you run in there and you pull your money. It's a cause and effect. Next thing you know, there goes all the cash liquidity a bank has, and you will cause a problem. So the Federal Reserve can have none of that. The administration will have none of that. Not even just the administration, both the houses. You can have none of this. Everything begins and ends with the banks. Don't Don't think for a second it doesn't. And the news with SVB is not good, but it's not the end of times either. I think what will end up happening is you're going to see most of the regional banks come out and declare that they are healthy as a bull, that they don't have the same types of portfolio exposures SVB did, because it was an incredibly aggressive lender and typical of California, irresponsible financially. So, uh, other than that, market didn't like any of this. We went red again. That means I think I noticed that the Dow was somewhere around -4, -5 for the year. So it's given up everything it made and then some. We'll continue to keep an eye on the S&P 500. I think we're going to see a little volatility. We've got the inflation numbers next week. I think this is going to be a choppy ride until we get those numbers. If we get those numbers and there's anything from they were just flat to they went down a little bit, I think that means Powell does a quarter of a point tops, and maybe he decides to sit on his hands for a month. I don't know. But I do think that this run on SVB is a scare. So, with that, I hope you have a great weekend. Uh, keep your powder dry, take your profits where you can, and be safe out there.